Hi, in this video I'm going to show you how to read a balance sheet. By the end, you'll not only know what each section means, but how to analyze it with financial ratios like a pro. A balance sheet shows your business financial position at one specific date, what you own, what you owe, and what's left over. The golden equation always holds true. Assets equals liabilities plus shareholders' equity. It's called a balance sheet because both sides must always balance. The balance sheet starts with current assets. These are things you expect to convert to cash within 1 year, like cash and cash equivalents, accounts receivable, inventory, prepaid expense, investments. Add them together to get total current assets. A pro tip is track how fast you turn receivables and inventory into cash. If those go faster than sales, it's a sign of cash flow strain. Next, we have property, plant, and equipment. Those are long-term operating assets like land, buildings, and equipment. Less the accumulated depreciation. This reduces the asset's book value over time. The result is total property, plant, and equipment, the true carrying value after depreciation. A pro tip here is compare accumulated depreciation divided by gross property, plant, and equipment to see how old your assets are. A higher ratio equals older equipment that might soon need replacement. Next, we have other assets, usually intangible items like goodwill, trademarks, or patents. Less accumulated amortization, that's the intangible version of depreciation. These can be big for companies with strong brands or acquisitions. A pro tip here is if intangibles are large, check whether they're still generating returns. Otherwise, they may need to be written down. Now over to the right side are current liabilities. These are debts or obligations due within 1 year. Accounts payable, money owed to suppliers for goods or services already received. Notes payable, those are short-term loans or credit lines that must be repaid soon. Accrued expenses, those are payroll, taxes, or interest that's already been incurred but not yet paid. Deferred revenue, that's money received in advance for products or services not yet delivered. Then you have your long-term debt. That's actually the current portion of long-term debt, the part of a long-term loan due within the next 12 months. Add them all together to get total current liabilities. A pro tip here is compare current assets versus current liabilities. That gives you your working capital. Positive working capital means short-term stability. Negative means potential cash flow strain. If a company has long-term liabilities, it'll be included here as well. These are obligations due after a year, such as bank loans, leases, or bonds payable. Add them to your current liabilities to get total liabilities. A pro tip here is look at the mix of short-term versus long-term debt. Too much short-term debt can strain your cash flow if sales dip. Finally, we have shareholders' equity, common stock, initial investment made by owners or shareholders when the company was formed, additional paid-in capital, extra amount investors paid above the stock's par value when purchasing shares, retained earnings, that's profits the company has kept and reinvested instead of distributing as dividends, treasury stock, shares the company repurchased from investors, reducing total shareholders' equity. Add those up and you have your total liabilities and shareholders' equity. This represents your company's net worth. A pro tip here is if routine earnings keeps growing each year, it means your business is funding growth with profit, not debt. Alright, so that's how you read a balance sheet. But if you want to go more in depth, then you'll want to analyze it with the key financial ratios I'll leave on the screen. If you can only know 5 key financial ratios, I would say current ratio, debt to equity, gross profit margin, net profit margin, and return on equity. Those 5 together tell you, can the business pay its bills? Is it using debt wisely? Is it profitable and efficient? And is it rewarding owners for their investment?